Hey, good morning, options traders. Well, in response to the last video about buying Gamma and Vega, I had a trader email really a related question about Delta and saying that how can you use Delta if you get a large change in the stock's price? So maybe in overnight trading, the stock gaps up 10 points. Well, I think most of you know that you really can't use your Greeks, Delta, Gamma, Theta, Vega, Rho, for large changes in whatever the factor is that they measure. So Delta, we're assuming that the stock price makes a small change, maybe 20 or 30 cents. And even technically speaking, that is too big, but it'll at least get you close. For Theta, we're assuming maybe 1 day's time has passed, and that will at least get you close. But what if, again, the stock maybe gaps up 10 points? Well, now we can't use Delta. But there is a little trick you can do that can at least get you close, and here's how you do it. So first, for a quick refresher on what Delta is, because we're going to be looking at this in just a moment, Delta and Gamma. Remember that Delta shows the options sensitivity to changes in the stock's price. So if the stock is trading for 100, the $100 call, let's say, is trading for 5. Broker's platform may show that your Delta is 0.6. And what this means is that whatever the next change is in the stock's price, this option will pick up 60% of that change. Delta is the percentage pickup, let's call it, of the change in that stock's price. So if the stock goes up $1, it's a fairly small change, this option will pick up 60% or 60 cents of that change. And so if the stock, let's say, rises from 100 to 101, that $100 call will go from 5 to 560. But again, the whole trick here, the reason that it works, is that it is assuming we are talking about small changes. Now, what about Gamma? Remember that Gamma shows the Delta's sensitivity to the stock price. So again, what it's saying is that if the stock price moves right now, how much will your Delta change? How sensitive is your Delta to changes in the stock's price? So let's go back to the $100 call trading for 5, Delta of 60. And let's say that now the broker's platform shows us it has a Gamma of 2 or 0.02. If the stock rises $1 right now, let's say from 100 to 101, our new Delta will be the old Delta of 60 plus Gamma. So our new Delta would be 60 plus 2 or 62. Now again, this is assuming small changes, so in the real world, it might not be exact. In fact, in most cases, it's not going to be exact because there will be other factors. There will be the passage of time. There could be changes in implied volatility, changes in the stock's price. So you have to understand whenever you're talking about these changes to an option's price, we are assuming that everything else is being held constant. We're working in a laboratory in a pricing model, and we're just changing that stock price from 100 to 101. And if that's true, yes, that new Delta would go to 62. But again, the question that we're trying to answer right now is what if the stock gaps, let's say, in overnight trading, and you're trying to get a handle on where your options price might be in the morning? So again, let's say the stock is at $100 call at 5, Delta is 60, and let's say that the Gamma is 0.02, stock gaps to 110. What's the expected options price? Well, what we're going to do is we're going to estimate a new Delta. And to do that, we're going to take the old Delta of 0.6, we're going to take our Gamma of 0.02, times the change in the stock's price. So remember that our stock is trading up 10 points in overnight trading, so 10 times 0.02 would be 0.2. Or we could say that we're going to pick up roughly 20 deltas. So if we add that to our old Delta of 60, that would be a Delta of 80. And what we want to do is find the average. So we're going to take the old Delta of 60 plus the new Delta of 0.8, divide by 2, and that's going to give us a Delta of 70. So if the stock has gapped up 10 points and we have an average Delta of roughly 70, and I say roughly because, again, we still have Gamma issues here, it's just going to get us a lot closer. But we know that that $100 call should rise by about $7. But you can see it's a much better estimate than saying it's going to rise by 6 if we just looked at this old Delta. So to see this math in action, let's jump over to a pricing model and do an example. All right, so now we're into the OIC's website. We've seen this calculator before. Let's start with the stock price of 100, strike of 100, 90 days to expiration, and 40% volatility. And the pricing model says that the call should be worth about 791, delta of about 0.54, gamma of 0.02. So if we made a very small change in the stock's price from 100 to 101, we would expect that this options price right here should pick up about 54 cents. And that's going to take us to about 845. So let's try it. Let's go 101. And pretty close. Off by a little bit, but it gave us a pretty good estimate. But now the question that we want to figure out here for this video, what if it's not a small change in the stock's price? What if it's 10 bucks? So if I make this $10 increase, let's say to 110, if we just use the old delta, we would expect this options price to go up by about 10 times delta, or about $5.40. And so that would give us an expected options price of about $13.31. So let's try it. Let's go 110 and see we're quite a bit off. It's actually $14.24. And again, this is because of gamma. We're trying to use too big of a range of stock prices to make our Greeks work. But again, what's the little trick we can do? Well, if I'm seeing it trade, let's say up 10 points in after hours, and I know that I had a delta of about 54 and a gamma of 0.02, I'm going to take my 0.02 gamma times the change in that stock's price, and that's going to give me 0.2, or about 20 deltas. I'm going to add it to this old delta. That's going to give me 0.73, or 73 deltas. I'm going to add that. That's what my new expected delta is, let's say, is 73, just with that calculation. I'm going to add it to the old delta of 0.54, and that's going to give me about 1.27. Now, of course, we can't have 127 deltas, but we're trying to find the average. So let's take 1.27 divided by 2, and that's going to give us about 0.63, maybe 0.64. So let's use 0.64 just for a round number. I'm going to estimate that my delta is really about 64 on average over this $10 range. Now again, it's not going to be exact because we still have gamma to contend with, but it's going to get us closer. So if I just pretend that I've got a delta of 0.64, and I know the stock is up 10 points, I take 10 times a delta of 0.64, I would estimate that this call would be up $6.40, which should give us a price of, that looks like about $14.31. All right, so let's try it. Let's come over here and try 110. And there it is, 14.24, so much closer. So that's really the basics of just how to estimate your options price if you get a big gap in overnight trading and you're trying to get a handle on where that option might be in the morning. Keep in mind that we still have volatility to contend with, and of course, prices could always change overnight. But if you're looking for a simple calculation, now you know how to do it. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.